All right, well, good morning. I'm going to go ahead and get started. It's 9:30. I want to be good stewards of your time, my time, and Phil, our presenter's time as well. So make sure that everyone's in the right place at the right time. This is one of our Hudson Valley Funders Network webinars, part of the Financial Health Series. This is Understanding Nonprofit Financial Health. We're very excited to have you here with us this morning. My name is Julie Brannon. I am the Membership Manager and DEI Specialist at NICON, and I'll be helping facilitate and moderate today's webinar. So I'm going to go over just a couple of quick housekeeping items, and then I will move out of the way and let Phil take over. And I mentioned, as a couple of you had come in from the waiting room, if you make sure that you remain on mute during the duration of the session today. We will have time potentially for some open questions at the end, but for the most part, we're asking everyone to stay on mute. If you have questions, we do encourage you, excuse me, I can't speak this morning, do encourage you to use the chat feature on the Zoom panel. So go ahead and type those in. Phil's going to keep an eye on those throughout the presentation. I'll be helping out with that as well. So let's make sure if you got questions, please use the chat box and we'll get those questions answered. Additionally, we are recording the session today, so we will send out a link to the recording and a copy of the slides to everyone that registered prior to this webinar starting. We'll get that out to everyone potentially later this afternoon, at the very latest tomorrow. We'll get that information out to you as quickly as we can. There are some captioning transcriptions at the bottom, so if you feel the need to keep those on, feel free to keep those on. If you find them a little bit distracting, you're more than welcome to hide those subtitles as well. There should be an option on your screen too, but we want to make sure that we are providing those and accessible to those that would like some additional transcription and the subtitles on there. So without further ado, I am going to pass it over to Phil Rosenblum from Tarn Consulting and to introduce himself and to get the presentation started. Phil?
All right, thanks very much, Julie. Hi, everybody, welcome. Thanks for joining us today. So my name again is Phil Rosenblum. I am a nonprofit financial consultant, financial planning consultant. I'm based in Poughkeepsie.
Yeah, go ahead.
And for the most part, what I do for a living is work with a pretty wide range of nonprofits, as well as some philanthropic institutions, to plan for financial sustainability. So that kind of ranges between a number of different projects. A lot of that work is helping nonprofit leaders, management and boards, get on the same page about what their financial condition is, what their financial needs are, and that's what we're going to be mostly talking about today. But it's also a little bit more sort of future-focused planning projects, you know, budget projections, cash flow projections, setting reserve goals, that type of thing. So I work with, again, a wide range of nonprofits, both in terms of the type of work that they do in, you know, human service fields, in the arts, in advocacy, as well as in terms of size, you know, small new institutions and larger longstanding nonprofits. So what we're going to talk about today is the first part of a two webinar series addressing financial planning for nonprofits, in particular in the wake of the circumstances that we have all been finding ourselves in for the last year in regards to the pandemic, which obviously has had some very dramatic impacts on a lot of nonprofits on their finances, as well as on a number of other fronts. So the two sessions are focused on sort of two cumulative pieces of the same kind of narrative. First, today, we're going to focus on making sure that nonprofit leaders have a sound basis on which to evaluate how their institution is doing financially. And we want to do that, not least of all, so that when you're engaged in financial planning practices, and we'll talk about a wide range of, you know, what those practices might entail, you're all on the same page about what you should be aiming for, right? We know, you know, when we're undertaking budgeting or, you know, strategic planning and the financial aspects of that, that we kind of know what we're aiming for, what financial health really looks like for a nonprofit. And so that's what we're going to be focused on today, is what it means for a nonprofit to be financially healthy, what our financial goals might be as a nonprofit institution. So that's going to involve a few different parts. First, we're going to be looking at just some key concepts in nonprofit financial health. This is going to involve looking at some amount of financial data and asking how we interpret that data. It's not going to be super technical. We're not looking to make everybody into an accountant by any means. I'm not an accountant. Really what we're trying to do is to figure out how we can look at financial data and concepts in a way where we can most easily pick out the pieces of information that are really important for us. Think about how to interpret that information in a fairly direct and concrete way. So we can ask, how are we doing from a financial perspective? So that's going to be kind of most of the presentation today. We'll then talk a little bit about the ways that the COVID pandemic has impacted nonprofit financial health. There's sort of a variety of impacts that it has had. So we want to think a little bit about how we consider our financial health in this particular environment. And then finally, to kind of prep us for the next session where we're going to be talking more about future focused planning, we want to talk about the respective roles that boards and board committees and nonprofit managers as well want to be taking in financial oversight and in financial planning processes. And then with whatever time we have left, there'll be just some open Q&A. So if folks have questions that are specific to their own organizations and you feel comfortable sharing those with the group, we can spend a little bit of time going through those. I'll also say that, as Julie mentioned earlier, you can at any point enter a question into the chat box. If there's something that I'm talking about that just seems unclear and you'd like a little bit of clarification in the moment, perfectly fine. And we'll do our best to be, monitoring those throughout the course of the presentation. Okay, so at a broad level, right, how do we think about nonprofit financial health? And perhaps even before we get to that, why is it important for a nonprofit to be financially healthy, right? We are mission-focused organizations. Why are we paying attention to financial health? So at a base level, right, nonprofits operate as businesses with some different financial dynamics than a for-profit business, but at heart, we are, financial entities like a business. And so you have to make sure that you're able to exist over the long term in order to continue to serve your community over time, right? And I think that's the major thing that we are trying to get at when we think about nonprofit financial health is how do we balance the investment we want to make in our programming, in aiding our community, with our ability to continue to exist and thus be able to continue to do that work over the long term, right? So that we're able to serve our community, not just today or tomorrow, but next year, a few years down the line, right? And I think that's at the heart of what it means to sort of be looking at nonprofit financial sustainability. So with that in mind, how do we begin to think about what it means for a nonprofit to be financially healthy? I would say that there are 4 key elements that I'm looking at when I'm working with clients to assess a nonprofit's financial health. And those are listed here, right? So first of all, you need to make sure that there is revenue that is reliably covering your costs. Generally we'll look at that on a year-to-year basis. And not just covering your cost, right? Not just breaking even, but in fact, ideally, for the most part, generating some amount of surplus, some amount of profit, for the reason that it's that profit that allows you to build up a little bit of cushion so that you can absorb some amount of risk, right? So that you can deal with bumps in the road that will inevitably come along for any nonprofit. So, a business model that reliably covers costs and generates a little bit of surplus, to me, is the number one thing that we want to be looking at for a healthy nonprofit. The next 2 elements are both kind of related to the balance sheet and the resources that a nonprofit has on hand, and we'll get into how you approach the balance sheet as we go through the presentation. So the first thing that you want to be aiming for is that you have enough access to cash. And ideally, that's flexible cash, meaning that it's not restricted to be used in the future. We'll talk about that concept as well, so that you can just manage the ebbs and flows of checks that you have to write and checks that come in the door throughout the course of the year, right? If you have a payroll that's coming up next week and you don't have enough cash until 2 weeks from now in order to be able to cover that payroll, right, that's a problem. And so having enough cash on hand to meet your expenses as they come in, that's the second aspect of financial health that we want to be focused on. The third also has to do with financial resources, probably cash, but it's sort of one step removed from day-to-day operations. And that's when we talk about reserves. Reserves we often think of as money that's set aside for particular purposes, to be used in particular ways, so that when something occurs that's outside the normal course of business, you have some amount of cash that can come in and absorb those costs or whatever that is, without spending down the money that you have to use to just cover cash flow day to day, right? So those are the three aspects of health that are really tied in a very direct way to financial performance and money that's actually coming in and out. The fourth one, which I think is equally important, is that you need to make sure that you have staff and board playing appropriate roles in management and oversight. Who is looking at information and when? What sort of discussions are you having about your financial strategy, your financial goals? Who gets to make what decisions about money in this institution, right? Having that as part of your ecosystem, right? Knowing who is responsible for what is really a critical element of financial health for nonprofits. So I would say that if you have those four things covered, chances are your nonprofit is probably in pretty good financial shape. And so we're going to spend the rest of the time today talking about, well, how do we assess all of these things, right? How do we know whether we have achieved these four building blocks of nonprofit financial health? So obviously for 3 out of the 4 of these, you're going to have to look at some financial data in order to assess how you're doing. And I think we can recognize that nonprofit data kind of comes into the hands of managers and board members through a lot of different forms, right? You might be looking at a lot of disparate sources of information, some of which you produce yourselves as a nonprofit, the budgets that you produce for the institution or for particular programs or for particular grants, the actuals that come out probably from an accounting system of some kind. You're looking at comparisons of budgets versus what actually happened throughout the course of the year. You may be using other internally produced financial planning tools, cash flow projections, budget projections, right? And then there's some sources of information that are, at least often, produced externally, or at least created along guidelines that are standardized from outside the organization. And then we're generally talking about audits or some other kind of review that's conducted by an outside accounting firm. And your tax forms, right? Your 990s, your Char 500 state tax forms, which you might fill out internally, perhaps, but the format of those is dictated, obviously, by the state or by the federal government. And so for folks who may not be super comfortable assessing financial information, it can feel a little bit overwhelming when you have all these different sources of information coming at you. And I think the good news about this, what we're going to focus on today, is that you can use a set of core concepts to look at all of these, right? You don't have to learn different things about nonprofit finance in order to be able to evaluate every single one of these types of documents, right? You want to hold those up to the core concepts rather than adjusting your concepts to look at these different documents. And so that's what we're going to be focused on today, right? Is what are the concepts that you want to be using to assess the information, regardless of which form it's coming in. The other thing, just sort of at an overarching level to address, is that there are 2 core types of accounting that, at least theoretically, your nonprofit might be using. The first is cash accounting, and that basically works in exactly the same way as you balancing your personal checkbook, right? When you write a check and money leaves the organization, that's an expense. When you get a check in and money goes into your bank account, that's revenue, right? And those are sort of the primary things that exist. The second type of accounting is more complicated but more thorough, type of accounting called accrual. And accrual is dealing not just with the money that's actually coming in the door and going out, but money that you owe to others, money that is owed to you, money that is promised to you, and in the form of pledges, for example. And there, revenue and expense are not necessarily counted at the time at which you receive a check, but rather the time at which revenue is committed to you, the time at which expenses are committed outside, right? So, if you get a Staples bill, an invoice, right, that you have to pay, the expense is counted at the time at which you receive that invoice, whether or not you pay it right away, right? So a more complicated set of information comes from accrual accounting, but it provides a much more thorough picture of what your financial situation is because it takes into account what you are owed and what you owe to others. Generally speaking, cash accounting is only going to be enough for very small, very financially simple institutions. For the most part, if you are dealing with a number of different grants that you're receiving or a number of different ways that revenue flows into the organization, you have salaried staff, you have a bunch of different vendors, things like that. Almost all nonprofits really should be using accrual accounting in order to get that full picture. And as a result, the information that I'm going to go through today is going to be focused pretty much exclusively on accrual accounting concepts. Although, even if you're running accrual accounting, you still obviously need to know about cash in terms of how much cash you have in the bank and how you deal with cash flow. But it's sort of one element of a larger picture of an institution's finances. And we're going to be focused mostly on that larger picture. Okay. So the first thing to know about nonprofit financial data is that regardless of what kind of financial report you're looking at, right? A budget, an audit, actuals from your accounting system, the information that you're looking at is basically going to come in one of two flavors, right? There is income statement information and there is balance sheet information. The income statement information is dealing with revenue, money flowing into the organization, and expenses, which are monies flowing out of the organization. And the difference between revenue and expenses is a surplus if you have more revenue than expenses, or a deficit if you have more expenses than revenue, right? And so this is the information that I think most folks are, pretty familiar with already, because this is what you're looking at, for example, when you're looking at your annual budget. This is the sort of stuff that's coming out with your profit and loss, for example, that when you pull that from the accounting system, pretty familiar to most folks. When you are looking at income statement information, the key question that you're always asking, right, whether directly or indirectly, is whether our business model is sustainable. Are we taking in, as we talked about sort of earlier, enough revenue in order to cover our costs and ideally to produce some amount of surplus? That's what we're talking about when we talk about financial sustainability for a nonprofit. The other thing that's important to know is that the structure of income statement information is that it looks at all of the activity that has happened during a given period of time, right? So oftentimes that's one fiscal year. So all the money that comes in throughout the course of the year, all the money that is spent throughout the course of the year, all of that time is compressed into this one statement, right? The other type of information is balance sheet information. And this is when you're looking at the financial resources that the organization has and what you owe to others. So the first type of information you're seeing on the balance sheet are assets. And those are just the things that you own, right? These are for the most part, very concrete categories. Cash is an asset. Investments are assets. Equipment, fixed assets that you've capitalized, those are assets. In accrual accounting, you also have accounts receivable, right? Money that has been pledged to you or promised you in a contract or something that you don't yet have in cash. That is an asset, is something that you own. On the other side of that statement are liabilities. So these are things that you owe to others. That could be debt, that could be it could be a mortgage, it could be credit card balances, it could be money owed on a line of credit, it could be accounts payable, right, which is the mirror side to accounts receivable. You got the Staples bill in, you haven't paid it yet, but you know you owe that money to somebody, right? So anything that your institution owes to outside parties, that's a liability. And then any of the value of your assets, which are not spoken for by your liabilities, those are your net assets, right? The net assets are the value that your institution has to call its own, free and clear of any obligations to outside parties. And when we talk about the term balance sheet, that's where the balance comes in, is that the value of the assets has to equal the sum of the liabilities, what you owe to others, and the net assets, the amount that the organization can call its own. So differently from the way that the income statement is structured, the balance sheet is not looking at all the activity that happens over a given period of time. It's looking at one day, right? It's like the balance in your checkbook, right? That you have one amount of money in your checking account today, but tomorrow, if you write a check or if you get money in, that balance is going to be different tomorrow, right? So when you are looking at these two statements together, right, the income statement should be able to explain all of the change that happens, for example, between the balance sheet that you generate at the beginning of that year and the balance sheet that you generate at the end, right? You might think of it, for example, as the income state, or excuse me, the balance sheet represents a photograph, right? A photograph taken at the beginning of the year and a photograph taken at the end of the year. And the income statement is like a video of everything that happens between those two photographs, right? So in the income statement, we were thinking about the sustainability of your business model. On the balance sheet, the key question that you're always asking, either directly or indirectly, is whether our organization has access to adequate financial resources, right? Generally speaking, to manage the ongoing course of business, to absorb some amount of risk, to be able to pursue new opportunities when we feel we should be, right? Those are the key questions related to balance sheet information. And I think the key takeaway from this is that in order to understand the financial health of your institution, you have to be looking at both sets of information. I think it is, the income statement type information may feel much more familiar, right? Because that's what we look at with our budget, and which is, I think the place that most nonprofit leaders feel most familiar with is the budget. But if you are only looking at revenue and expenses, you cannot get a whole picture of whether your nonprofit is financially healthy. You've got to be looking at balance sheet information as well. And in fact, the two sets of information are always interconnected, because every time you have a surplus, your net assets, the amount of resources that you have for the organization, free and clear of what you owe to others, your net assets increase with every surplus, and your net assets decrease with every deficit, right? And so if you have a series of deficits in a row, you can get to a point where you have no more value to call your own, right? That you have eroded all of the financial resources of your organization. And that's when you start getting into real trouble, right? Not being able to meet expenses, et cetera. So these two sets of concepts, income statement and balance sheet, sustainability and adequacy of resources, is at the heart of every single financial conversation that you're going to have, right? Management, board, looking backward, looking forward, everything is going to come down to these two sets of concepts. So the interesting thing is that this works for nonprofits in exactly the same way, for the most part, that it works for any kind of small business or any kind of corporation, right? They're looking, for-profit businesses are also looking at income statement and balance sheet information, right? But nonprofits have a couple of different layers of additional complexity that are critical for understanding whether specifically a nonprofit is financially healthy or not. And of these differences, by far, the most important is the concept of fund restrictions. So unlike for a for-profit business, money that comes into a nonprofit can't necessarily be spent in any way that you might please, right? As soon as a for-profit business, a small business takes in money, you can spend that money on anything that you want to. Not so for nonprofits all the time. Why? Because some nonprofit money is restricted, meaning that a donor or a funder from outside has told you that it must be spent on specific things. And so in order to understand whether our business model is sustainable, whether we have access to adequate resources, we need to know how much of the money that we have is restricted or not at a given period of time. So I want to just look at the different levels of restriction, right? On the left in green, we look at unrestricted money, which is the most flexible, right? And frankly, the money that you want if you're able to get it, right? So anytime you have a fee for service arrangement, you deliver a service and then you get paid for it, right? That's going to be generally unrestricted money. Anytime you have sales revenue, for a product that that you might be selling, that tends to be unrestricted. Contributed revenue can also be unrestricted. Generally we talk about general operating support or unrestricted operating grants that come from foundations or corporations. All of these monies can be unrestricted. So as soon as they come in the door, you're able to spend them on whatever you need to. The next level up are temporarily restricted monies. And so things like program grants or multi-year grants where you get, let's say, $50,000 grant and 25,000 of it is for this year and 25,000 is for next year, right? The piece that has to be held over either until a later period of time or until you do certain programming, those are going to be temporarily restricted funds. So temporary restrictions apply to revenue, but never to expenses. There's no such thing as a restricted expense. Instead, what happens in nonprofit accounting is that when you reach that period of time where you're allowed to use the money, or when you do the thing that you're supposed to be doing with that money, you have what is called the release of restricted funds, right? And essentially the revenue flows from that yellow box into the green box and becomes unrestricted money, and then it can be spent, right? The final category of restriction is permanently restricted money. And here, almost always, we're talking about an endowment. So somebody donates some funds, often in the form of investments, or you get the money and then you invest it, right? And then you never spend that original money that you have received. Rather, the investment income, investment gains, and interest and so forth that are generated by those investments, that money is available for you to spend. And it's that money, the gains that, again, flow over from restricted into unrestricted, and then you're able to spend them, right? So when we are looking at your income statement, for example, in a given period of time, and we want to see, do we have enough revenue to cover our costs? If you are looking at all of the revenue that came into the organization, regardless of whether it is restricted for a future period or not, you can fall into the trap of sort of thinking that you have achieved a surplus, right? Because you have more revenue than expenses. But if a meaningful portion of that revenue is not actually available for you to use in this period, you may not actually have a surplus, right? We need to know how much revenue was truly available, was unrestricted, either because it came in the door unrestricted or because it came in restricted but has been released for use. Do you have enough unrestricted money at the end of the day to cover your expenses? I think in particular, this can be a tricky thing because for a lot of nonprofits, the information that comes out of your accounting system, for example, may not explicitly break this out, right? When you get, if you're running QuickBooks, for example, and you run a profit and loss, it may not necessarily distinguish this amount of money is unrestricted and this amount of money is restricted. And so I think it's important when you are looking at your financial performance to be regularly asking the question, okay, we have this profit and loss here. It seems to suggest that we have a surplus. Is all of the revenue that's reflected in here really available for us during this period? Or does this report include money that we are supposed to be setting aside for the future? And if we do have some money that's set aside for the future and we take that out of the equation, are we still covering our costs, right? That's going to be a really critical step when we're doing financial oversight. Fund restrictions are going to apply to revenue, as I said, but also on the balance sheet. When you're looking at the balance sheet, and in particular, your net asset balances, right? The money that you have free and clear. Also, to some extent, when you're just looking at how much cash you have in the bank, knowing, is part of that set aside for future purposes and not really part of the operating cash that we have available to be just, meeting our payroll or whatever else it is right now. It's important to be able to differentiate those things. And if your accounting system doesn't produce that information in a way that is clear, right, then when you're looking at reports internally as a management body or as a board, it may be helpful to sort of, have some additional documentation or some notes or whatever that clarifies, where you're at on a purely unrestricted basis. I think with those concepts, right, income statement and balance sheet, what we're looking for in those statements, understanding the role that fund restrictions play, I think you have really the primary building blocks of being able to look at your financial information and interpret, right, what you are seeing there, knowing that the types of questions that you want to be asking. So I want to then move on and just look at, well, when we're looking at this information and using these concepts to, to assess our data, what should we be looking for, right? I think the first thing, when you're looking at income statement information is, again, surpluses. And I think this can sometimes feel a little bit, countercultural when it comes to nonprofit management, because I think there's often a pressure to not show a profit, right? To sort of spend down as much money, in particular on program, as possible in every given period. But that's not a recipe for financial sustainability over the long term, in particular because it's the ability to generate surpluses and build cushion that allows you to build cushion over time. And it's that cushion that allows you to absorb financial risk and deal with emergencies when they come up. You're not generating surplus in order to, have profits that you distribute to shareholders or, buy a private jet or anything like that. We're mission-focused organizations, but we need to ensure that we're able to continue to execute our mission over the long term, right? It's unlikely for most organizations that the community need that you're addressing is only going to happen this year, right? These are, generally speaking, long-term community benefits that we're hoping to provide. And so we need to make sure that our institution is preserved over the long term. And that's why, having some amount of surplus, being able to build up some cushion over time is really important. So then people often ask, well, if we know we need surpluses, how much should we be aiming for? Is it a certain percentage of our budget? And I think here that a sort of one size fits all metric, a percentage of, how big our surplus should be is not probably going to serve you very well. I think instead, what you should be looking toward is what are our financial goals, and we will circle back to development of financial goals a little bit later today. So how much do we need to bring in order to address our financial goals? And then can we hit a target for our surplus that allows us to move in some kind of meaningful way toward that goal over a reasonable period of time? For example, if just, let's say that one of your financial goals is to build up a $100,000 reserve, right, for any variety of purposes. If you have a policy that says we want to generate $1,000 of surplus per year, you're not going to hit your target for 100 years, right? That's probably not enough surplus to allow you, right, to meaningfully address your goals in a reasonable period of time. You might be looking for something more. So I think it's that sort of conversation that you want to be having that says, when we think about a policy that says how much surplus should we be pursuing, it's in the context of what you're really aiming to achieve. I think it's also, important to note that in some circumstances, planning for a deficit in a given year can be perfectly reasonable. If you, for example, are investing in a big programmatic expansion or some other kind of, growth in the organization, and that's going to involve more upfront costs that will eventually be covered by revenue that's going to start coming in the door, but just not this year. And if you have enough cushion, right, if you have enough reserves or whatever else to be able to sustain that loss without having a problem with cash flow or anything like that, it can be perfectly responsible to have to plan for a deficit in a given year. You just need to make sure that you have a trajectory, right, where you know how long it's going to take you to get out of that position, and that you're not going to sort of incur, a series of deficits that really erode your working capital, for example. It has to be sort of a limited time arrangement. But in those circumstances, that could be fine. So if we know we are aiming to produce surpluses, how do we go about achieving that? And I think really what we're talking about here is understanding what your nonprofit's business model is. And the term business model is sort of used in a lot of different ways. The way that I'm going to use it is to refer to the overarching system through which money usually, for the most part, flows in and out of your organization, right? So what are the revenue streams that you tend to count on the most? How reliable are those over time? If you have different programs within your organization and then perhaps sort of an administrative budget that sits over in a different place, right? Which parts of your program are profitable and which lose money, and how do the ones that produce profit subsidize the ones that produce deficits, right? And I think that's another area where nonprofits are financially different, right? Is that we're mission-driven organizations. And so you may well run a program that loses money every single year, and it is always going to lose money, but it's mission critical. It is something that your community needs. And so you will continue to run it even though it loses money. That can be fine, right? Plenty of nonprofits do that. You just need to make sure that there's some other part of your organization that produces enough subsidy, right? Enough surplus to fill that gap. And so understanding that system by which money flows within the organization and into and out of it, that's what I'm referring to as the business model. So it's not just a question here of how much money is flowing in and out, but how reliable it is, right? When we think about the business model, we're thinking about how things generally happen reliably over time. And you may have some ways that money flows into or out of the organization that is not part of the regular course of business. So a lot of us, for example, had PPP money come into the organization this year, and it provided a real financial benefit. But that's not something you can count on year after year, right? You might have, for example, a bequest, a large amount of money that comes in when a donor passes away, provides a real benefit, not part of the normal course of business. Those sorts of things obviously can happen on the expense side too, major investment in a technology platform or something like that. And so when thinking about what your business model is, I think it's really helpful to think of things that are part of the normal business model and then extraordinary events that happen outside of it, and to understand, the extent to which your ability to cover costs is dependent on money that is reliable and to what extent it is being funded by money that is extraordinary and non-repeatable. And that's one of the major questions I think you want to ask when you're evaluating your financial performance is, can we repeat the performance that we had this year over and over again, assuming it's positive? I think that when we look at these business models, right, how they work, we can just talk about a couple of different examples of this. And I'm going to share a couple examples. They are for sure oversimplified, right? Nonprofit business models can be very complicated, and I just want to look at a couple of very simple examples to understand sort of what I'm talking about, when we refer to a business model, right? So you could have one type of business model that is generally reliant on program overhead, right? So here we have an institution that has 3 programs, A, B, and C, and then you have an administrative budget. The expenses are reflected in yellow, revenue is reflected in green, right? So there's some amount of administrative, unrestricted money that comes in, right? General operating support, for example, I don't know, sublease of your facility, who knows, right? Money that's not tied to a specific program, but it's not enough to cover the full administrative cost of running the institution. However, you have 3 programs and they're funded by, who knows, some combination of grants or contracts or fees. And each one of those programs brings in enough money to cover the direct cost of doing the program, plus some overhead, right? Plus some additional amount of money that can be brought back over to fund the gap in the administrative budget, and not just fill that gap, but you see that dotted green line over the top, to produce enough surplus, right? And so in this situation, the fact that you never have enough contributed revenue for the administrative function to cover its own costs, not really a problem, right? Because you can get subsidy from other places. So this is one example, very simple, right? Example of how a business model could work. Here's sort of the opposite situation, right? You have programs A, B, and C. Program C is able to cover its costs, but programs A and B lose money reliably, right? As many nonprofit programs do. However, in this case, that's okay too, because this organization has a really robust sort of central fundraising function, right? Is able to bring in enough general operating support, not just to cover their administrative costs, but to fill the gap for those programs that don't make money, right? And above and beyond that, to produce some amount of surplus, right? This, this is also, it can be a perfectly reliable, perfectly sustainable way to run a nonprofit, a perfectly sustainable business model. And I think, the major point that I would make here is that oftentimes when I work with clients, folks ask the question of, we are aiming for a particular percentage breakdown. We want to make sure that we have at least, X percent earned revenue versus we don't want to be relying on grants and contributions, or we want to make sure that all of our programs are able to cover their own costs, right? That's a goal of ours. And my advice in these cases is to sort of back up a little bit from the demands that you're making of particular revenue streams or particular program economics, and ask the broader question of, is our institution as a whole reliably able to bring in enough money to cover costs, to produce some amount of surplus? And if so, then can we provide individual programs or individual parts of the institution a little bit more flexibility, understanding that, again, because we are mission-driven organizations, not every program is going to be able to, cover its own costs automatically, right? And I think it's, when doing financial planning, that process of sort of like backing up a level and looking at the whole picture, sort of thinking of the institution as sort of a financial ecosystem, right? Where different parts support other parts of the institution, to me tends to be a really productive way of thinking about a nonprofit's financial health. All right, so this is sort of the general aspect of looking at business model sustainability, right? Like whether we're able to cover our costs and so forth. In the next session, right, the one that's happening 2 weeks from now, we'll dive into a lot more of the specifics of how to structure your planning, whether it's budgeting, whether it's projections and that sort of stuff, that, dive into the weeds on these topics. But this is sort of the general philosophy that you want to be pursuing when you're looking at this kind of data. So then we want to shift over to the next aspect of financial health, right, which is on the balance sheet. And the first aspect that we're looking at there is liquidity. And that's the question of whether you have enough funds on hand to cover costs when they arise. So the type of data that you want to be looking at for the most part here comes from the balance sheet, but here it really is useful to look at some metrics, and in particular, liquidity metrics that are phrased in terms of how many months of expenses can be covered by the resources that you have on hand right now. it's a way of asking how much runway do we have based on the resources that we have today. So there are two different calculations that you could do in order to ask this question. One is just looking at cash, and this is the most straightforward, right? You just take your total cash balance and you divide it by 1 month of expenses. And you can do that just by taking your annual budget and dividing it by 12, right? So cash divided by 1 month of expenses tells you how many months of cash you have right now. And the advantage to this is that it's a very concrete measure, right? We all know what cash is. We need to use cash in order to pay, pretty much all of the costs that come into the organization. And so this is a very direct way of looking at how much flexibility we have to manage the ebbs and flows of expenses that are coming into the organization. The disadvantage to just looking at months of cash is that it doesn't take into account the fact that you may owe cash in the form of liabilities to others, right? So that some of the cash you have may be spoken for by short-term liabilities. It also doesn't take into account fund restrictions, right? So it is not so uncommon for nonprofits to take, a grant that's supposed to be set aside for next year and borrow the money from that grant in order to meet payroll because you need access to cash today. And then say, by the time we get to the program that has to be funded next year, we'll have other cash come in the door and we can repay that grant, right? Sort of borrowing and repaying from your own future. If you're just looking at months of cash, that figure is not going to tell you whether or not you're borrowing from your own future. And so there, you might want to turn to a more complicated metric, but it's sort of a more thorough, more conservative metric, which is unrestricted liquid net assets. And here, you might really be turning to your, for example, to an audited balance sheet to make this information really clear rather than trying to sort of dig through your QuickBooks reports or something like that. But basically, you're taking your net asset amount from your balance sheet, and in particular, the unrestricted net assets, or the language these days that's used is net assets without donor restrictions. It's the way that it's reported on audits now. And you want to subtract out from that the portion of that value that is related to any physical stuff that you own, right? Some of your net assets can reflect, a part of your building. If you don't have a mortgage, or your mortgage is not the entire value of the building. If you have equipment, other physical stuff that you own, that can be part of your net assets too. And so you need to subtract that out to figure out how much of that is truly liquid. And you can divide that amount by 1 month of expenses. The advantages to this measure, right, is it tends to be more conservative because it takes into account the fact that there's restricted funds in there, there's money that's owed to other parties in there, right? And so you're not going to sort of give an overly optimistic picture of your liquidity. The downfall, as you can probably tell, is that it is both, less straightforward, less tangible, and it's just more complicated, right? Knowing how to interpret that information can be a little bit trickier. But I think that oftentimes the best way to think about whether you have access or how much access to liquidity you have is to look at both of these measures side by side. And if they're really different from one another, figure out why, right? Is it because we're borrowing from our future restricted grants, for example? Is it because, we've got, a lot of debt, that we're having to pay down, and over what period of time do we have to pay down that debt? That sort of thing, right? Looking at, oftentimes, when you're doing financial analysis, it's not just about finding the right number to look at, but looking at a bunch of different numbers and figuring out how they connect to one another, right? That's really what the analysis is about. So if you are, doing these calculations and you come up with a number, we have X number of months of cash on hand. So what, right? How do you know whether a given number is good or not good, better or worse? So, again, there is sort of a one size fits all metric that folks tend to use here, which is that nonprofits that have 3 months of liquidity, that tends to be the benchmark at which you have some amount of comfort in dealing with your ongoing cash flow, right? And if you don't have access to any other target, right, if you haven't done any other internal analysis, sure, look at 3 months worth of liquidity, as a place to start, a place to aim for initially. But it's also worth noting that there are a lot of nonprofits out there that operate on less and do so for years or decades and are able to sort of eke by. And so I think that it can be a lot more helpful to really develop your own target, right, for how much working capital you think you have to have access to. And that can really depend on your annual cash flow cycle. So if you're an institution that reliably gets, 1/12 of your money in throughout the year every month, right? It's evenly divided and there's always money coming in the door. You may be able to get by with a little bit less liquidity at the beginning of the year, for example, because you know that there's always money coming in. If you work for an organization that gets a gigantic portion of its total revenue for the year in at one time, right? Either because you do educational programming and you get all your tuition in at the beginning of the year, or you have a big gala and that's a really big piece of your revenue throughout the course of the year, and that happens at the end, right? 3 months at the beginning of the year may not be enough for you, right? Because you're going to have a long dip before the next, bump of revenue that comes in. And so I think looking at the pattern through which money flows into the organization throughout the course of the year, it's going to give you a more custom, more valuable goal, to evaluate whether you have access to enough working capital. And I think that's if you have the capacity to do that, undertaking that analysis, asking that question of yourself and setting a target with reasoning behind it is a good exercise to undertake. So that's one piece of balance sheet health. The next is, right, above and beyond the liquidity that you need for everyday cash flow, reserves, right? And I think that the piece about reserve planning that oftentimes falls by the wayside for nonprofits, right? Folks tend to know, ideally we should have a reserve, right? But oftentimes money is put into that kind of reserve and set aside without any clear policies around either how much do we want, what's it supposed to be used for, what are the policies through which we can borrow it, and do we have to repay it after we borrowed it, right? There's a lack of reserve strategy, right? And it's just money that's sort of put aside in a suitcase, right? Hopefully not literally. I think that reserves are much more useful when they have an explicit documented strategy around them. And in fact, if you don't have that strategy, setting aside a reserve can be counterproductive, right? Because you've just sort of put money aside and it just sits there with no real reason or purpose for what it's supposed to do. And then nothing happens with it, right? And that's money that potentially could be used to just sort of manage your cash flow, for example. So what are the types of reserves that you might want to be thinking about? I think first and foremost, for a lot of organizations, you might be thinking about some kind of rainy day fund or operating reserve. It, could be other terminology used for the same thing. And all that is saying, we know what the normal course of business is like for us, but we also know that, the unexpected happens, right? We lose a key grant with short notice, right? We were counting on this grant to fund our programs this year. It's not going to come in. A rainy day fund might be there to continue to allow you to do the programming and incur the costs until such point at which you can identify a replacement revenue structure, right? You preserve the community benefit, you preserve the service provision, and you're doing that in a way that doesn't deplete your working capital in such a way that, for example, that you're not sure you're going to have enough cash flow to be able to meet your payroll, right? You don't want to be in that position. The reserve, the rainy day fund provides like a pressure release valve from a financial perspective. It could also be not just revenue loss, but also unexpected expenses, right? There's some sort of cost, extraordinary cost. Maybe it's not even unexpected, but just, you're hiring a new position and it's going to be some time before the revenue to cover all of that person's salary is readily available, but you want to hire them now for a variety of administrative reasons or whatever. you can pull from the rainy day fund in order to do that. Similarly, but sort of on the more optimistic side of things, you could have something that's like an innovation fund, right? Where you want to start a new program, and be able to invest some seed capital in getting that program off the ground, but you don't want to again get yourself in a place where you don't have access to enough cash flow. And so you can pull from this innovation fund in order to get that program off the ground, with the idea that ultimately it should be able to produce enough revenue to cover itself, or otherwise be sort of incorporated into your overall business model in a way that it's not producing an extraordinary drain eventually, right? This money, again, provides like some wiggle room, right? It provides room for programmatic flexibility for your organization to be nimble in responding to community need, right? You need some amount of financial cushion to do that. You also might have an organization that has a lot of investment in fixed assets, right? You own a building or something like that, and you're going to have to make a big investment at some point. You got to replace the roof, you got to replace the boiler, whatever it is, right? These are big ticket items, and it's preferable to be able to pull that money from some sort of reserve that's set aside rather than having to rely on your working capital to cover those costs. Right, so these are just some examples. You don't have to have reserves that fit exactly into these categories. They can be more purpose specific to your organization. They could be more flexible, right? Where you could have something that's a rainy day fund or an innovation fund. It could be used for either purpose, right? You can determine that as a leadership body to your organization. But whatever you decide in terms of what the purposes of the reserves are, what amount you're targeting to put into those reserves, I would very much encourage you to formally designate and document what those reserves are, how you intend to fund them, over what period of time, how much you ultimately want to put in them, and have formal adopted policies for when you can draw that money. What are the processes that you need to go through in order to spend it internally, right? When do you need to seek board approvals? When can management decide things on their own, et cetera? And should these reserves have a repayment policy, right? So that any monies that you borrow from them have to be repaid within the course of a year or 6 months or 3 years or whatever it is, right? So that when you get to a point as a leadership body where you want to utilize the reserve, you don't have to circle back and say, wait a minute, is this really what we wanted to do with this money? Might there be other things we want to do instead, right? You have set policies that you've established in advance that everyone has agreed on and formally adopted by the board, and you can utilize the funds in the way they were intended, right? I think that's sort of the heart of having a reserve strategy. And so that gets us a little bit into roles and responsibilities as well, which is the final building block of nonprofit financial health from the beginning of this presentation. But before we get into that, we're still talking a little bit about financial data and financial health, in terms of numbers, right? I want to talk a little bit about the pandemic and how we might think about the way in which the pandemic has impacted our nonprofit's financial health. And so I think, it's important to start here by saying the impacts of the pandemic on nonprofits were certainly not isolated to the financial realm, right? There is all sorts of stuff that nonprofits have had to deal with in addressing the pandemic within their organizations, right? How does it impact the needs of our community? Are we able to respond to those community needs? Like, we have to deal with the physical health and safety of our employees, of our volunteers, of our community members. How do we do that, right? We're having to make a bunch of dramatic changes really quickly to how our organization runs. At least at the beginning of the pandemic, we were. How do we go about making those decisions? Do we have policies that are up to snuff, et cetera? I don't want to sort of ignore that whole range of challenges that folks have faced, but today we're really talking about one particular concern coming out of the pandemic, which is with all of the changes to the way that money flows in and out of the organization as a result of what is going on in the world. How do we preserve the financial viability of this nonprofit institution so that on the other side, we can continue to serve our communities, right? That's really what we're aiming at here. And so with that, I know that I think the first thing that comes to people's minds oftentimes is, we had to change the way that we did programming, or we had to cancel some events, or we had to, shut down some aspects of our operations, perhaps for part-time. And so what does this mean for revenue flowing into the organization? Do we have less revenue that is coming in than we did otherwise? Have we lost revenue, right? And clearly that's a very important question, but in and of itself, it is not enough to tell you what the pandemic's financial impact on your organization has been. And I think that's because the pandemic not only impacted revenue, but also expenses, right? So there's a survey conducted by the Center for Effective Philanthropy this year that just looked back retroactively and asked folks a whole series of questions, but particularly in regards to finances, says, did you have revenue overall increase or decrease? Was your community demand up and down? Did costs increase or decrease? And as you can see, by this pretty simplistic chart, right, there were a wide range of impacts for nonprofits on all of those fronts, right? The majority of nonprofits, as you can see up top, saw revenue decline overall, almost 60%, but almost a full third actually saw their revenue increase throughout the course of the pandemic, right? At the bottom, in terms of costs, things are a little bit more, spread out evenly, right? So more nonprofits said that their revenue decreased than saw their cost decrease, but still it's, more than a third of nonprofits saw their overall cost decrease. And when we think back to the looking at the sustainability of our business model, right? The question that we're asking is, do we have enough revenue to cover our costs? And so if both of those things are moving targets, the fact that you lost money, might be offset by how much you reduced in terms of costs, right? And we can see this also in terms of the various decisions that nonprofits took throughout the course of the pandemic. This is from that same CEP survey, right? So the vast majority of nonprofits, 88%, changed their program offerings in some way. That I think at this point feels fairly obvious. But there were also very large chunks, of this sample at least, that said, they did less programming, provided less service in some way. Again, revenue implications potentially, cost implications potentially, right? Some undertook specific strategies, almost half undertook strategies specifically to reduce their administrative costs. Some drew from reserves. So one would imply from that, right, that they intentionally, or perhaps not intentionally, incurred a loss, but they had reserves to draw from. And so they said, we're going to continue to provide services and let our reserves or absorb some of that loss, right? And there's other things on the staff side, right? Furloughs, layoffs, obviously, painful decisions that some nonprofits have had to make. But again, from a financial health perspective solely, reduces the cost base that has to be covered when we're thinking about the sustainability of our business model. So I think what I want you to take from this, right, is that to understand what the pandemic has meant for your institution's financial health, you need to do some analysis of your organization's financial data, right? It's not necessarily that all nonprofits came out or have come out of the pandemic to the extent that we hope we are coming out of it now, financially damaged. Many nonprofits came out of the pandemic actually financially stronger than when they went in, oftentimes because they had some combination of extraordinary money coming in the door, PPP, extraordinary donations or whatever, and a reduced cost base because they had to close or because they took measures to reduce operational costs or perhaps personnel costs, right? So you really need to ask a series of questions about your organization's circumstances in order to get a handle on what the pandemic has meant for you financially. And so, what might those questions be? First of all, yes, did you lose program revenue? Did you lose a big grant or a contract? But when you ask that question, If we lost that contract, did we also stop doing that program? And if so, were there cost offsets? And were the cost offsets bigger or smaller than the revenue that we lost, right? Looking at that, not on a gross revenue basis, but on a net basis is going to be more informative in terms of the impact on your finances. Did we see a big increase in our community demand? I know just as one example, right? Food banks, saw an immense increase in demand. Folks who were providing some sort of emergency direct support, to folks who were dealing with loss of employment or other economic hardships, saw a substantial, very dramatic, very quick increase in demand. Did that lead us to have to spend a lot more money on doing our programming? And did we have any revenue sources to cover that or not? Right? Did we make the decision to expand programming because our community needed it and have to sort of deal with the financial implications afterward? A lot of nonprofits had restricted grants, multi-year grants, program-specific grants, and their ability to deliver the programming was hampered. And a lot of philanthropic foundations or other grant makers said, you know what? This is now general operating support. Use this money for whatever you need in order to have your institution survive in this period, right? And that was a substantial financial boon for a lot of organizations. Why? Because you keep the money, but potentially the cost of running the program, at least some of it, might go away, right? So an improvement to your bottom line on a net basis. Did you have a big influx of extraordinary fundraising, right? The individual donor base stepped up, especially right at the beginning of the pandemic, in a really major way. Both grassroots fundraising and major donors for a lot of institutions. There were a lot of nonprofits who I've worked with over the last year or so that had really dramatic windfalls of individual donated revenue. Not all of that's going to be reliable over time, right? You're not going to be able to repeat that performance, but it might have, improved your reserve, improved your financial cushion in this period of time. There are certainly a whole bunch of other questions that you might ask yourself. These are just a few of the key ones that I've experienced in working with nonprofits over the last year. The critical thing here is that looking at any one of those issues in isolation is not going to tell you how your nonprofit fared. For most nonprofits, right? You need to ask all of these questions, figure out all of the impacts that the pandemic has had on your financial operations. And the cumulative result, right, is what you're going to be working with, right? Did our organization as a whole have an unexpected deficit, an unexpected surplus? If we had a surplus, what are we going to, if we had a big unexpected surplus for any variety of reasons, what are we going to do with that money, right? Are we just assuming automatically that we'll spend it down, some of it or all of it down next year, right? Are we setting some of it aside? If so, do we have a reserve strategy, that gives us an idea of for what we are setting that aside? If we had a deficit and we eroded some of our reserve or eroded some of our working capital in order to absorb that deficit, how does that leave our balance sheet right now? Do we still have access to adequate financial resources, adequate liquidity? Did we spend down the reserves that we had set aside? What does that mean for us, right? These are the questions that you really want to be asking yourself at the institutional level. And then second, you want to know what pieces of our performance from 2020 are just extraordinary in nature and things are more or less going to go back to normal next year, this year, 21 or next year. And which pieces of that represent lasting change, maybe not permanent, but longer term change in how money is going to flow in and out of the organization, right? In what ways do we need to think about the possibility that we didn't just have a blip in 2020, but that we need to think about our business model working in a different way on an ongoing basis coming out of the pandemic than when it did when we came in, right? So you're dealing with a lot of big questions, a lot of change, a lot of uncertainty. And so that kind of gets us to the last piece, which is about appropriate roles and responsibilities for nonprofit managers and boards. So in this period, when you have all of this extraordinary stuff going on, I think the main point that I would make is that now is the time for both managers and boards to step up when it comes to financial management and financial responsibility, right? And that has both more kind of abstract or philosophical implications, right? For example, making sure that you have a consensus between management and the board about how you are going to balance mission and financial considerations as you make decisions over the next year or so, right? Because those sets of decisions are not always going to point you in the same direction, right? You know, investing more in our community because they need it and we don't know what the financial considerations are going to be. Being concerned about the ongoing financial viability of our organization, and so perhaps pulling back on program delivery because we're worried about our, you know, our ability to continue to exist a couple years from now, right? These things may pull you in separate directions, and so having an understanding of what is it most important for our organization to do, how do we prioritize the mission needs and the money needs against one another when we have to, right? That sort of philosophical issue is something to really bring to the forefront in times of uncertainty. And it also has more kind of logistical implications, right? So, you know, if your board is, you know, not meeting regularly, if your board is not regularly looking at financial information or not having really, you know, informative discussions, sort of strategy-oriented discussions about your financial performance, if you don't have a finance committee that is meeting regularly and really devoting time to financial oversight outside of regular board meetings and informing those regular board meetings, now is a really good time to get that stuff in order because you're going to need more oversight, more participation in financial strategy now than you did before. I think also just from a policy perspective, it's really important to have some consensus around what financial decisions managers can make, like the executive can make on their own, versus what types of decisions need board ratification in order to make, right? You don't want to be in a position where there's, you know, discord between management and the board about who made what decision without checking or what have you, right? So if you don't have policies and procedures that address those things, now might be a good time to think about that. You know, assuming you have the capacity to do so. So, you know, how do we think about the division of responsibility between management and board, both of whom have really substantive responsibilities when it comes to financial management? So this is another place where a one-size-fits-all approach is not going to serve everybody, right? Nonprofits are very different in terms of the staff capacity that they have. Some nonprofits have entire fiscal departments. Others only have one paid staff person or none, right? And so you can't always say that, like, this is exactly how you divide between staff and board, right? Some boards may need to be more involved in the logistics of the fiscal system than others. But I would argue that wherever you find yourself, what you want to generally be aiming toward is a situation where the board is generally responsible for governance, meaning oversight and strategy around financial issues, and management is generally responsible for, you know, the day-to-day running of the fiscal function in executing the strategy that has been approved by the board. Ideally, that's where you want to be aiming. And so that can play out in a lot of different ways, right? It could be that the staff generates the annual budget, that the staff and the board review that budget together, certainly you should be doing that, and that the board has to approve the budget, right? So board does approval, staff does execution, right? And you come together to review and discuss. Similar with, you know, the financial reporting package, staff, you know, or contractor, whoever produces the reporting, you get together to look at that information and review the implications, and the board may make a series of decisions about changes in what you're doing based on what that discussion holds. One place that can sometimes be a sticking point is about compensation for paid staff. Generally speaking, the executive is the head of management, right? The executive role is going to be in charge of setting compensation for paid staff, with the exception of the executive themselves, and the executive's compensation is going to be set by the board. There's a little bit of gray area here because, of course, the board has to approve the overall budget, and the overall budget cumulatively reflects every single person's compensation. But I would argue here that, generally the board, for an organization that has multiple paid staff, the board ideally does not want to be making decisions on a person-by-person basis about how much everybody is paid, but rather approving the institution's compensation budget as a whole. And then the only one person that they actually do set their salary for would be the executive themselves. So this is generally kind of the ideal division, right? Where you have approval, strategy, policy on the board side, and execution, day-to-day management, right, on the staff side. And then you come together to review and discuss. However, these things play out in your institution because of the staff that you do or don't have, because of the board capacity you do or don't have. The roles and responsibilities that you are going to abide by should be documented, right? You should have a policy and procedure manual that lays out who is responsible for what, when does reporting have to be delivered to whom, in advance of what meetings, who runs the meetings, who sets the agendas, right? These things should be established and written down so that if something doesn't happen at the right time or in the right way, you can go back to that and say, here's what we agreed on. It didn't happen this way. Do we need to just fix how we're doing things, or do we need to think about a change in policy, right? Having a set of written policies as a touchstone can be really helpful in that way. So the other point, and this is really for the board members who are on the phone or on the webinar today, is that all board members are responsible for the financial condition of the organization. All have equal fiduciary duty, whether or not you're the treasurer, whether or not you're on the finance committee, whether or not you consider yourself a numbers person or a finance person. As a board member, you must be engaged in understanding the financial condition and your nonprofit's access to financial resources as part of your fiduciary duty. So what does that mean? Generally speaking, all board members should basically understand how nonprofit finance works at a level sort of like what we're talking about today, right? Revenue and expenses, surpluses and deficits, assets and liabilities, liquidity, right? This general stuff, you should have a handle on it as a board member. You should be participating in a meaningful way in financial planning and oversight, right? And that can be a little bit different, what meaningful means, depending on whether you sit on the finance committee or not. And we'll talk about that in a minute. But, a budget approval process where, the executive brings the budget to the full board, presents it, asks if there's any questions, and then there's just silence in the room, and then you take a vote and approve it. Not ideal, right? You want to be having a substantive discussion of what this budget means for our institution. You want to be participating similarly in conversations about explicit financial strategy, explicit financial goals. And on a technical side, you're responsible in part for making sure that reporting requirements, audits, 990s, that sort of thing are met. Now, that's not to say that there's no differentiation amongst the board about how deeply you go into these issues, right? So you should have a finance committee. That finance committee should meet outside of the board meetings because the board has a whole range of responsibilities. You can't devote all your time to finance, and finance can be sort of a finicky topic, right? Like you need to spend a lot of time going through a bunch of information. So the finance committee is there to go more in depth, more detail, more extensive discussion, so that you can then bring the findings of that committee meeting to the full board so that the board can vote on whatever they need to vote on, right? You're reviewing the same information. The finance committee is just reviewing it probably in more detail, more extensive discussion, et cetera. And the board, in most cases, will have the ability to actually vote, right? To approve the decisions recommended by the finance committee. And so I think having this structure requires a finance committee, one that exists, but also that meets regularly in advance of regular board meetings. You may also have an audit committee that meets separately from the board meeting and specifically deals with selecting an auditor, overseeing the audit process. Audit can also be folded into finance committee. It certainly is for many institutions. Either structure can work. The finance committee also, by the way, as any committee, can and should have a charter, right? A document that says, here's what the finance committee is here to do. Here's how often we're going to meet. Here's who's in charge of setting the agenda. Here's who reports back to the board, right? These written explicit guidelines that make sure people know what they're supposed to be doing can be a really valuable piece of this oversight system. And, right, when your finance committee meets, ideally, it should not be that like the financial reports go to the committee an hour in advance of the meeting, and then your committee gets together and just spends their meeting time, taking a first glance and asking, what does this line item mean? What does that line item mean, right? That's not going to lend your sort of time together. It's not going to make it the most effective, right? Ideally, what you want to have is that the finance committee receives the reports well in advance of the meeting, at least a couple days in advance of the meeting, that everyone on the committee commits to reading through those reports and getting questions out of the way, like factual questions out of the way before you meet, so that ideally you can spend your time together in a group, having more strategic discussions. We look like we're going to have a budget shortfall. What do we do about that? We look like we're going to have a surplus. How do we sort of fund our reserve goals? That type of strategic or policy discussion, is really the most effective way to use your time as a group. And so the extent to which you can facilitate that rather than just having 5 people in a room or on a Zoom kind of looking at a document together is going to make your time more effective. So what are the major times, aside from just general oversight, when you're going to want to be really engaging your financial oversight and financial governance system, right? The core one, of course, is the annual budgeting process, right? And I think that the key point here is that what is your annual budget? It is a reflection of your institution's strategy for that year. And as a result, when you're looking at the budget, it should be clear to you how the numbers on the page reflect what your institution is planning to accomplish in that year. And if it's not clear, right, that should be a discussion to have. And it can be helpful, by the way, to facilitate that, to have the budget come along with a text narrative, right, some prose that explains not just here's why the grant line is $700,000 instead of 6, but to say, here are the major things that our institution is planning to pursue this year, and here's how the numbers in the budget apply to those goals. Our personnel is going up because we're making a major investment in our development department so that we can produce more, et cetera, right? The next thing you're going to want to make sure is that the assumptions in your budget are adequately conservative, meaning, right, if we are not quite sure how much revenue we're going to bring in, as nobody ever is, that you are estimating a little bit on the lower range rather than on the higher range. Why? So that the surprises that come throughout the course of the year, as they always will, are more likely to be good surprises, which are easier to deal with, rather than bad surprises, which are harder to deal with, right? So, you generally want to be assuming revenue is a little bit lower than you might hope, that expenses are a little bit higher than you might ideally like to keep them, right? Not a doomsday budget, not, worst case scenario, but what you decide to be a reasonably conservative look at what might happen next year. Again, so that you're more likely to be surprised in ways that things go better than expected rather than worse. You want your budget to aim for a surplus for the reasons that we've talked about before, and you want to understand how this year's budget relates to budgets and actual activity that you've had in the past. So if your organization has a 20-year track record of bringing in, $100,000 a year in individual contributions, and this year's budget shows that you're planning on receiving $200,000 from individual contributions, you should have a discussion about that, and you should have a really good reason why you're going to double what you've done any year in the past, whatever I said, 20 years, right? If you're seeing a major departure from everything that has happened before, that brings in a question of are our numbers adequately conservative, right? So some reasoning behind that. Those are some of the major questions you want to be engaged in Again, the finance committee is going to talk about this in detail, with the board having a higher level discussion, higher level but substantive discussion about how budget relates to strategy, and then ultimately approving that budget. And then if you just pass the budget and then never look at it again, it doesn't serve really any purpose. You need to make sure that you're checking back throughout the course of the year and how you're doing against that budget, right? The budget versus actual report coming from your accounting system can, be sort of the primary way to address that. And so the main thing that you want to look at is our actual performance departing in material ways from what we thought was going to happen this year? If so, why? Is it because we're too optimistic in our projections? Is it because we've just had something unexpected happen, right? Do we need to adjust our spending plan because there's going to be less revenue than we thought and we can't afford to incur a deficit, right? Having your interpretation of these financial reports tied back to your financial strategy for the year, right? You may change course in what you decide to do for the year based on how the year is playing out. And then a somewhat longer term note, right? Should the variances between what we thought was going to happen and what actually happened this year lead us to take a different approach when we are planning for next year, right? Do we sort of look back and say, you know what, we always sort of say that we're going to bring in 100,000 in individual contributions and we never hit it. So this year we should probably just budget less unless we have a really good reason to think otherwise, right? Or something like that, right? Really kind of taking lessons learned from financial oversight throughout the course of the year and applying them to your next year's budget process, right? Makes this whole thing, more valuable from an oversight perspective. In these times in particular, when we're dealing with a lot of risk, when we're dealing with a lot of uncertainty, I think it can be really helpful to look specifically at risk management from a financial perspective as a governing body. And a lot of that, I think, there are too many different concerns and different questions to be addressed in a piecemeal fashion all at the same time, right? Especially if you're in a time of financial stress. And so I think the first thing that nonprofit leaders can do, management or board, is try to prioritize your planning efforts so that you are dealing with the biggest impacts that happen on the shortest time frame. And so often that means asking this sort of series of questions. First, do we face immediate cash flow gaps, right? Do we have a payroll coming up next week and we don't think we're going to have the cash to be able to meet that payroll? Any other longer term financial concerns that you have are going to be secondary to something like that that's big and immediate, right? If your cash flow is relatively secure for the next few months, ideally 6, 12 months, something like that, once you feel stable about that, you can move on to annual budgetary questions. Are we going to have a deficit this year? Can we deal with that? Right? Can we absorb a deficit by spending down reserves, or do we need to institute a plan B, spending cuts or whatever it is, so that we do not incur a deficit because we cannot afford one, right? And then similarly, once you have that in line, once you know what you're going to do for the year, you have a plan that's going to get you to a point of financial viability for this year, you can start asking longer term questions about, are there going to be lasting changes to our business model? Do we need to sort of rethink our approach to reserves? Do we need to sort of consider larger changes to the way our institution works over time, right? But those questions about long-term change to the business model are not things you should be spending a bunch of time on if you don't know where next week's payroll is coming from, right? So it's a question of prioritizing so that you deal with the most immediate risks first. So obviously that's a relatively pessimistic set of concerns to deal with, but there's also the mirror image of that, right? Which is that financial oversight involves goal setting, right? More positive, optimistic set of concerns. And here, I think the important thing is that you should be setting financial goals that are relevant to the place where your institution is right now, financially speaking. So I've got these categories here. Obviously, these things aren't set in stone. These aren't firm divisions. These are just some general concepts, right, of different places that your institution might find itself. So if your organization is really in a place where you need to stabilize financially, you keep losing money, you don't have enough cash to like comfortably manage cash flow, you're always sort of scraping to get through a payroll, you're borrowing from next year's restricted funds, some or all of these things apply to you, right? This is not a time when you're going to be sort of, for example, thinking about an endowment, right, for long-term sustainability. That's not where you should be focused in terms of financial goals right now. It should be, how do we fix our business model so we cover our costs? How do we get to a place where we have enough cash on hand where we don't worry about payroll anymore, right? These are the types of goals that you should be aiming for, when you're setting a financial strategy. When you're a little bit past that, when when you've sort of moved beyond those immediate risks, you have a little bit more flexibility to think a little bit longer term. Maybe you switch to thinking about, building a rainy day fund, building a little bit more cash cushion so that, so that you're not sort of just getting by, but that you're getting by with some amount of, flexibility if a grant comes in later than expected or whatever, and then as you progress towards more stability, more predictability, well, or at least not necessarily predictability, but adaptability anyway, in what you're facing this month, next month, this year, et cetera, you can think about longer term concerns, building up, the, innovation reserve, building up a facility reserve to last you over a longer period of time, thinking about how you can preserve programmatic flexibility and continue to, serve your community, over the long duration, right? 10 years or more. But those long-term considerations are not probably worth a lot of energy if you are dealing with these conditions on the left side of the page, right? It's matching our goals to where we are right now. But with that said, right, making sure that you are in fact establishing clear financial goals, establishing a clear financial strategy that is supposed to achieve things for your institution. I think that a lot of nonprofit financial management and governance is very reactive, right? Because sometimes it has to be, right? We lost a grant, what are we going to do? We need to hire someone, we don't feel like we can afford it, what are we going to do, right? And certainly you have to deal with those things, you can't pretend otherwise, but making an effort to deal with those issues and then be more proactive in establishing a financial strategy and a set of goals, I think can be a really beneficial thing for an institution, right? To set yourself a roadmap for where you want to head. Certainly you're doing so on a programmatic standpoint, but to do so also on a financial standpoint, I think is very important. And so then the last piece of this is just to recognize that because there has been so much disruption to the way that nonprofits have done business over the course of the pandemic, that has no doubt been a really risky, a really unfortunate, a really damaging thing for many nonprofits, right? In terms of the ability to serve our communities, in terms of, in some cases, our financial sustainability, et cetera. But if we were going to look for a silver lining in this, one of them is that it has freed up many nonprofits, just sort of emotionally, mentally, culturally, within their governing bodies, to consider, is there a way like that we can operate differently in the future than how we have done for years and years, right? The expectation that everything we have done in the past, we must keep doing, that assumption has been, maybe destabilized a little bit for some nonprofits. And so for those who have the capacity, to do so, it may be a good time to think about whether it is worth, making more lasting, more substantive changes to the way our institution is structured and how it works financially. And that could be a whole range of different things, right? It could be that, we have some programs that we've been doing for years and years, and people are familiar with them, but we don't necessarily think they're the most central to our mission. And if they don't also have, a positive financial impact for us, this may be a time to consider whether it is appropriate to keep doing those things, right? Or whether we should refocus our efforts on, the most critical community needs, the things that we do best, the things that we do that no one else does, et cetera. It may be a time, there's been a lot of shift in staffing over the last year. It may be a time to think about whether our org chart is structured in the way that's most effective. Should positions work somewhat differently? Should lines of reporting change? Should our staffing model change in some way? Are there ways in which we think about, different administrative structures, which could be, we all have a lot different experience with remote work and video conference over the last year. Does that make a change in how we think about our need to preserve office space and the costs that come with that? That's one example. Obviously, there'll be many others. But I think that it is unfortunate, I think, if nonprofit leaders go through this period just automatically working under the assumption that our institution should be aiming to get back to exactly how we were before. Maybe that's the best answer. For some nonprofits, it will be. But I think this is a point where certain questions which were existed below the surface can be brought to the surface and asked in an intentional way, potentially to the benefit of your institution, financially as well as programmatically. So having some sort of explicit planning process, whether it be a strategic planning process or business planning or what have you, to address those questions. This can be a good time to deal with that sort of thing. So on those sort of big picture questions, this is sort of the end of the sort of formal presentation piece of this. I want to move on and just sort of have the remainder of our time up until 11:30, if we need it, be available for Q&A. But before I do that, I just wanted to point out that, with all of these big questions and planning processes and roles and responsibilities and all that sort of stuff, it can be a lot to take on, right? For many board members and nonprofit leaders and managers and everybody. And so if you are interested in some one-on-one follow-up support to address some of these questions, there is some availability through the Hudson Valley Funders Network for organizations to pursue that, and we can so we can find some time to spend a little bit of time. I can provide some coaching or guidance, and so you can contact NICON. In particular, Susan from NICON, their contact information is there on screen. You'll get this presentation, by the way, in PDF, so you'll have access to this. And you can find out about your institution's eligibility for that follow-up work if you're interested. I think it varies somewhat depending on what county you're located in and so forth. With that said, I just want to open up the rest of the time to any questions that folks might have about really anything that we've covered today, or anything that's kind of adjacent to what we've covered today. And we can use as much of this time up to 11:30 as we need. I don't know, Julie, if you had anything else that you wanted to share before we just sort of had folks type any questions into the comment box.
Yeah, I dropped a link to the session survey, and again, I'll follow up with an email with Susan's information, so you can follow up for consulting. I'll leave the session survey link. I'll also leave the recording link, and as soon as we get the slides from Bill, we'll send that out as well. So we'll send all of that information out to you as soon as we have that put together. While I'm saying all that, if you have questions for Phil, you want to drop those in the chat box. You should be able to unmute yourself, or if you want to raise your hand, I can unmute you for yourself, or if you're able to do it, just why don't we do that? Why don't we have you raise your hand if you'd rather speak, and then if not, you can drop it in the chat box. So if you have questions, raise your hand or drop it in the chat box.
And is that an actual, physically raising your hand, or is there a button that says raise hand?
There's a button to raise your hand. So hit the raise hand button. I know not all of you are on camera, so I can't see you actually raise your hand. So hit the button. And of course, if you have questions that you think of after, because I typically find myself in that situation, I'm always like, oh, wish I'd thought of that earlier. You can reach out to Susan. We'll get you connected with Phil or through myself, because all that information will be coming from me as well. So, I'll fill in this awkward silence moment with letting you know that if we need to. So, I do see something that came into the chat box, Phil. Do you want to take a look at it? Can you see
Yeah,
that?
sure. Yeah, so yeah, facilities renting versus owning. A very good question, and certainly a big financial decision. For pretty much any nonprofit. I think it is, like many things, dependent on the actual alternatives you're looking at, right? The specific rent that you're paying for what specific space and how the owned facility might respond to those needs better. I think that when considering purchasing a facility, oftentimes, right, the general wisdom of in favor of facility ownership is that your organization builds equity, right? That the amount you're paying, for on a mortgage or funding through capital campaign or whatever, becomes value that the organization owns for itself, as opposed to rent, which goes out the door to a landlord. And it's much the same for your own personal finance. And I think that the things those advantages can be real, but in a more concrete way, if the building that you're going to buy is necessary for you to provide services in, right, or to house your operations or whatever it is, it's probably unlikely that you're going to sort of sell the building to get access to that equity. Yes, you could get some sort of loan against that equity potentially, but that comes with its own costs. And I think with facility ownership comes a whole other series of expenses that you're incurring in place of rent, right? Certainly, debt service if you have a mortgage or anything like that, with the principal and the interest and how that's going to impact your cash flow, but also maintenance, both sort of ongoing maintenance and utility costs, the regular operating costs of running the building. And extraordinary capital repairs that are going to happen periodically. And so, what is your organization's ability to deal with the cost of, I don't know, replacing a boiler, replacing a roof when that happens? Do you have enough cushion or reserve, or to be able to deal with those periodic things? Is one thing that you're going to want to be looking at. And the other is, I think a lot of nonprofits purchase facilities in order to facilitate growth in their institution, right? Like, you don't have enough room, you want to be doing more programming, you want to be hiring more staff, you don't have the room for them in your rented facility. And so you're thinking, well, instead of renting a new place, we might want to buy a place instead. And so the thing to recognize there is that when you undertake that growth, for nonprofits, being bigger doesn't always mean that it's easier to cover costs. In fact, the opposite is often true, right? New funding for programming, doesn't always cover the cost of doing that programming, or hiring those people or whatever it is. And so it is, I think, a lot of folks, when they're thinking about whether to purchase a facility, they're very focused on the transaction of acquiring the facility, right? Like, how do we get the money to buy it, right? Or to finance it, or what have you. And that's critical, obviously. But I more often see nonprofits get into financial trouble, not at the point of the transaction, but in the next year or two after they acquire the facility and move into it and start doing more programming, because the ongoing growth in the institution, combined with the maintenance and utility cost of living in the space, plus potentially the debt service, in combination, get them into a place where they're not able to cover their costs on an annual basis. So I think, that doesn't mean that facility ownership is never a good idea, but I think I think that it's not a question that can be asked in the abstract, right? It's something that you should be undertaking some really structured, explicit financial planning around. And that financial planning needs to address not just the transaction, but also some projections about how the organization is going to exist financially in a sustainable way after the facility is acquired. Hopefully that was helpful.
Great, thank you, Phil. Any other questions? I haven't seen any other ones come through or anyone raise their hand, so, or hit the raise hand button. All right.
Okay.
Well, we'll go ahead and close this out. Again, big thank you to Hudson Valley Funders Network for sponsoring this webinar, and a huge thank you to Phil with Tarn Consulting. I'm going to pass it back over to Phil to close things out and some last words from him. So, Phil?
Yeah, thank you. Yeah, thanks everybody for coming. I hope this was valuable. I know it's kind of a lot of information. The next session, by the way, right, 2 weeks from now on the 21st, it's in the afternoon though. You can register via Nikon's site if you haven't done so already. It's going to build on what we've talked about today, right? So it's going to be less in, about sort of general concepts and more about, what should the budgeting process look like? What should the format of the budget and our financial reports or financial projections or whatever that, we'll get into some more concrete aspects of planning processes. And I'd also say, feel free to reach out to Nikon, and see your eligibility for the one-on-one coaching, because I'm, certainly available for that. The resources out there. So thanks everybody very much. Enjoy the rest of your day.
Thanks, Phil. Thanks, everyone. We'll see you next time.
Bye.